Hello, good afternoon, everyone. My name is Gan Leong, and I'm the Senior Portfolio Fund Manager from KAF Investment Funds. I appreciate the time you have taken from your busy weekend to attend my presentation today. Today, I will be sharing you the outlook of Malaysian equities and essentially where and what we are going to invest in the next 6 months. Let's begin. Okay, so let's start and look at it from a global perspective. In this chart, we see the performance of various asset classes since pre-pandemic. So we, time and time again, when we speak to people, when they ask, stock market have done really well. I think I spoke to several investors just now. They say, well, your funds have been doing well, market have been doing very well. Maybe I wait for the market to see some sell-off first before I invest. Now, if you look at this chart, you can see that only 2 indexes that's doing well, that's actually up in positive regions since pre-pandemic levels, which is the MSCI World Index and the Bloomberg Commodity Index. And the reason why the MSCI World is in positive region is essentially because of its high compensation in US equities. As of today, close to 70% of the index comprises of US equities, and that is one area that actually done really well. But if you look at Asia, things look a lot more bleak. MSCI Asia Pac is barely breaking even in the past 4 years. It's 4 years of performance and it's actually going nowhere. And if you look further in and zoom in where we are today, Southeast Asia, MSCI ASEAN is actually down close to 20% since its pre-pandemic level. So the pandemic rally that everyone keeps talking about, it did not happen to us. The ASEAN region did not actually recover to pre-pandemic levels. Hence why I see there is opportunity in the ASEAN region. Now, if we zoom in and look at this chart, this is the performance of the key ASEAN indexes since 2013. So this is a 10-year performance, and it's priced in US dollars. The reason why we price in US dollars is for standardization purposes. So it's easier for us to compare between different indexes and also to take account of the weakening of several of the currency within the ASEAN region. Now, if you look at this table, only Indonesia is doing really well in the past 10 years. And not really well, okay. It's up close to 30% in 10 years. But look where we stand. For a foreign investor, if you're a US dollar investor, for every dollar you put in Malaysia 10 years ago, you'll be left with only half of what you have. Of course, we do not take account of dividends in this chart, but nevertheless, we are far behind our regional neighbors. We're not talking about comparing to the American markets or the European markets. Comparing to our Southeast Asian neighbors, we are down by a significant amount, thanks to the depreciation in the Malaysian ringgit, as well as our local equity market have been very disappointing in the last 10 years. Now, this is the performance of FBM KLCI against the small cap index since the end of 2013, 10-year performance comparison. Now, we do not take account of the yearly annual dividends that you receive every year. So if just simply by the reference point, the price point of the benchmark pricing, what we can see is that FBM KLCI is down close to 20%, slightly more than 20% actually, in the past 10 years. If you account for the annual 4% dividend yield that you were to get, if you were to invest in the KLCI, you'd probably be up about, 20%? But of course, there's still some bright spots in Malaysia. FBM small cap is actually up about 5 percentage points, not accounting for dividends. Probably accounting for dividends, you're looking at about 20% positive in the last 10 years. So the outperformance of small caps against the large cap in the long run is actually quite significant. Like if you look at this table alone, last 10 years, the outperformance is close to 26 percentage points. So that's why we think it's unfair for investors to just shun small caps, which is very common nowadays. A lot of people tell you, stay away from small caps. Small caps are dangerous, risky. I think there's a misconception here where we always confuse volatility with risk. Of course, if you look at a shorter time frame, then volatility, yes, small caps is a lot more volatile. But if you were to look at in a longer time frame, and if you're a long-term investor, then the volatility will smoothen out. And small caps do give you that alpha that you're seeking, especially in Malaysia. Because in Malaysia, you don't get much beta. You see, the market return is very disappointing. So if you were to buy KLCI or large caps, you probably not make money. You might as well just put it in fixed deposit, right? So in the last 10 years, you know, small caps is the one that actually give you the alpha that people are seeking. So for us, that's what we have been looking for. We try to have some informational advantage, and that's where we think that as active fund managers, we play a role. Warren Buffett, you know, I think a lot of people heard many times where Warren Buffett constantly mentioned that, you know, you're better off investing in ETFs, you know. Mutual funds are unlikely to outperform ETFs. That's true in America, but you can't replicate that strategy in Malaysia. Simply because if you were to invest in a KLCI ETF, you'll be barely making money. So I think in Malaysia, active fund managers still have a role to play. Every year, I think on average, we actually have 300 to 400 meetings with corporates. And sometimes, you know, a lot of these companies that we meet, no one actually covered this stock. So that's where we think we can add value, looking for these companies that are undervalued, where no one is appreciating, and, you know, business is doing well, and that being the one of the first investor in this company will give you the sizable returns that we're looking for. Now, Malaysia in general. So by default, every year, you know, corporates should grow about 5-6 percentage points, simply because you look at two factors here. One is your GDP growth. Your real GDP growth, you know, hovers between 4-5%. You know, it hovers around that region, and then you got your inflation rate. So on a nominal growth perspective, we are looking at, you know, rule of thumb, 5-6% growth every year. So the problem in Malaysia is our PE have derated in the last 10 years. If you look at this table, the 10-year average PE is 16.3 times. We are at 14.6 times right now. If we were to re-rate back to its 10-year average of 16 times, there alone we'll get a 10% upside, you know, excluding any potential earnings growth. So we think that how the market can re-rate is largely due to sentiment. A lot of times you look at, you know, markets going up 20-30%. Look at Japan this year. Japan's up, 2023. Japan is up, 28% in 2023. A lot of the returns came from PE re-rating, not so much on earnings growth. And why? Because sentiments have changed. People start to feel better about Japan. People think that inflation is coming back in Japan. You know, so people start to plow into Japan, and that's why the PE re-rated, and that's where you get your returns. Because if you're just solely, you know, reliant on earnings growth, you're going to get your real GDP growth plus your inflation rate, which is usually hovering around low single digits. So what we want to look for is what can drive the sentiment in Malaysia to improve in the coming months. Now, foreigners is something that can push stocks up, because there's a big difference between foreign buying and institutional buying. I will explain it later, but if you look at this table, right now we broke the new low. Foreign shareholding in Malaysian equities by market capitalization stands at 19.5% in December 2023. The high was 27.5% in April 2007. Now, we broke the previous low in 2009 during the subprime crisis. So right now, foreigners are just not interested in Malaysia, you know. And it makes sense. I mean, the earlier graph I've shown that, you know, if you were a US dollar investor, for every dollar you invested in the last 10 years, you'll be left with half your money. Why would you be interested, right? But nevertheless, I think if there's a positive momentum, foreigners will come back. The Japanese market have been very bearish for a very long time, have been lagging behind. But yet, when things start to improve, when sentiment start to improve, people start to come back in. So there are a few factors that's going to help us this year. Number one, if the outlook on ringgit improve, that should help the Malaysian equities. So we have the problem in Malaysia right now is the interest rate differential between Malaysia and the US interest rate, which is quite a significant amount. Right now, we are only at about 3% interest rate. Who would put money in Malaysia, right? So I think that as interest rates have peaked in the US, ringgit should start to strengthen against the dollars. So that may actually attract some foreigners. And number two, our government, our current government actually is quite insistent on fixing its fiscal position. So that's why we are starting to talk about subsidy rationalization. And these things, foreigners like a lot. So foreigners may take interest. And if they start to see improvements in our economy and in markets doing well, I will not be surprised that foreigners will start to come back in, especially when there's very little foreigners left for now in Malaysia. A lot of these 19.5% are your foreign funds that are domiciled in Malaysia or foreign funds that have to invest in Asia. And most of them are underweighting Malaysia anyways. So there's room for upside there. Now, if you look at this table, foreigners have continued to shun ASEAN equities. Which area did really well last year? What foreigners like? Korea and Taiwan. These are the only two areas that actually shown strong inflows last year. And even from Taiwan's perspective, there were actually net outflow all the way up to October last year. Only last 2 months of the year where they see significant inflows in Taiwan. And why these two markets did really well? Because they are seen as the tech proxies in Asia. So a lot of foreigners bought this market in the last quarter of 2023. It coincides with that strong Nasdaq performance we saw in Q4 last year. And what drove that performance? When Fed came out and speak and people think that interest rate have peaked. So that's when people believe that, okay, it's time to go back into tech stocks. Because there's an inverse relationship there. Sadly, this didn't happen in Malaysia. Now, if you look at the sectorial breakdown of foreign buying and selling in 2023, in the first half of last year, actually foreigners were aggressively selling Malaysian stocks. But it started to turn in the second half. Where foreigners start to come in the second half of the year, what did they buy? They invested in utilities, property, construction, and technology. That's where the foreign flows went in. And in utilities, the 5 stocks that did really well last year was actually a beneficiary of foreign inflows. So number 1, YTL Power attracted the most foreign inflows last year. YTL Corporation, Gamuda, Maybank, Frontcan. So these are 5 stocks that actually attracted the most foreign inflows in 2023. And look at the performance of these stocks. You see, earlier I mentioned before, foreign buying and local institutional buying, it's different. Yes, it's still buying, both are net inflows, but the magnitude is different. When a foreigner buys in, they are not very price sensitive. They just want exposure. So they will just buy, limit order, they will just buy the stock up. They don't really care about that few cents. When institutional buy, we are very, very sensitive to the price that we pay. We will park a limit order at a price that, we are not going to go more than 1 cent more than what we want to buy. If the stock go up, we're not going to buy, we're not going to chase. That is the way institutional have been buying. Hence why, your colleagues are usually market makers. When people dump the stock, they will come in and buy, but they will never chase things up. But foreigners are different. When foreigners want a position, they will buy, regardless of price. They will chase the stock up. So time and time again, you look at historically, stocks that did really well and saw very steep upside, steep runs are foreign buying. It's due to foreign buying. We saw it in, during the COVID era, glove stocks, a lot of foreigners came in, pushed up the stocks. This aggressive foreign buying is the one that pushed stocks up. And we are seeing with the YTL group of companies. This year, YTL group of companies did really well. I think YTL Power, YTL Corporation, stocks that we have in our portfolio, our top 5 holdings, did really well. It's simply due to the strong foreign buying. So what do I like? Where will I put my money in? There's 2 areas that we really like right now, 2 sectors. The first sector that we really like, oil and gas. So why oil and gas? I think the reason Petronas Activity Outlook report, they did highlight that, they're going to spend 60 billion. It's about 40% higher than what they have spent on average in the last 5 years. Now, but if you zoom in further, you start to see that the hookup commissioning and activities are going to see a significant increase. You look at that table above, the number of man hours that was contracted last year, 4 million man hours. What Petronas anticipate for this year? 7.6 million man-hours. So we're going to see a significant spike, in activities. MCM is expected to increase by 13% in 2024. Then if you look at it from an OSV perspective, oil support vessels, last year Petronas utilized 337 OSVs for offshore projects. This year, they are expected to utilize 397 OSVs, which is an 18% increase. Based on our channel checks with oil and gas service providers in Malaysia, a lot of them highlighted that, there's a shortage of equipment right now. And a lot of them are actually demanding for higher prices. So for the new contract renewals, that, because some of them signed 2-year, 3-year contracts, those expiring contracts are going to be renewed at higher prices. So you're going to see some margin expansion there. Furthermore, why I like this sector? Because a lot of people don't like it. The valuation is very attractive right now. We're looking at oil and gas services company trading at single-digit PE, and we are anticipating strong growth. For us, it's quite simple. If we can invest in companies that are going to exhibit and demonstrate that they could grow this year at single-digit PE, 7-8 times, if they were to rate back at 10 times, we are looking at 25% return on our investment. So these are something we look at. So we think from valuation perspective, it's attractive. So there's room for PE re-rating, so for the multiples to go up. And from an earnings growth perspective, we think it's positive for this year, especially when most oil and gas services company, their biggest client is Petronas. And when Petronas say that they're going to spend, they're going to invest, it gives you an indication where it's going to hit. So we are very optimistic of oil and gas right now. Another area that I like is tech. I like tech because I think that we have been a big laggard, last year. If you look at the table down there, the KL Tech Index versus the Philadelphia Semiconductor Index, the Malaysian tech stocks have been moving in the same, have been similar movements with the Philadelphia Semiconductor Index for the past 9 years. 8 years actually. But last year was where the big disparity happened. The Philadelphia Semiconductor Index, which we call SOX, was up 60-odd% last year, whereas the Malaysian Tech Index was, I think, down a few percentage points or flattish last year. So there's a big disparity, hence why you can see the disparity in performance. Prior to that, they move in the same direction. Similar, they have a very high correlation in their movement. So we think that, number one, there's room for Malaysian tech to catch up. The reason so is because in America, of course, they talk, there's AI plays, and then also in America, people buy ahead, anticipate ahead. Malaysia, we tend to like to wait for earnings to deliver first. And like it or not, last year, tech earnings were very disappointing. And if you ask me, I think it will stay disappointing for the first half of this year. To be fair, I think Q1 this year, most companies will report quite disappointing results. Simply because you have your festive season, you have Chinese New Year, and in March, I think you got your fasting month, and then your Hari Raya in April. So I think it's going to be a relatively quiet and slow quarter for Q1. And then Q2, that's when things are going to start to pick up. So I think consensus right now, the market consensus is tech will come back, semiconductor will come back in the second half of this year. If you look at the World Semiconductor Trade Statistics forecast, last year semiconductor sales were down 9.4%, but it's anticipated to go back up by 13.1%. So it's an improvement from the previous projection in June that they've given. Previously, I think they were anticipating about 11% improvement this year, but now they have upgraded it. And then, of course, the Malaysian tech sector should benefit from trade diversion. Given that, right now the US-China tension is not improving anytime soon. So we think that's one area that we will actually benefit on, simply because our ringgit is so cheap. Right now, 4.6? It's extremely attractive for foreigners to set up factories here. So we are going to see more diversion. It's just that we just need to get our things right, attract more foreigners to invest in Malaysia. But by default, the whole demographics itself, it's very attractive for foreigners to invest in Malaysia. So generally, I think that there's still a lot of liquidity in the market. If you look at this table, money markets mutual fund in US is at 6 trillion, close to 6 trillion right now. So there's still a lot of liquidity in the market despite the QT. And you know right now why inflation is not coming down as quickly as people want it to? Simply because pandemic savings have yet to be exhausted. But based on recent data, I think only the T20 still have excess savings, whereas the rest are starting to run out of savings to spend already. So that's why we are starting to see inflation data taper off. So that should benefit the tech sector as well. So I think that right now people are anticipating 3 rate cuts this year. I think that there's potentially more than 3 rate cuts if inflation were to come down quicker than expected. I think in the recent core PCE data, we are starting to see on a 6-month annualized basis, it's coming down at 2%. It's actually close to the 2% rate, so it's close to the Fed target. So I think there is room for tech to go up in the sense that if there's more cuts than expected. So if you look at the current US Fed balance sheet, it's still at elevated levels. But nevertheless, the US Fed did mention that they are going to look to still go on with the QT and reduce their balance sheet. So you have to look at it from another perspective. Of course, some can say that liquidity is taken out from the market, so valuations should derate back to where it was previously before Fed started that pump priming. But also in the sense that if they were to take this more prudent measure, if market were to weaken, if things were to weaken globally, they will have room actually to cut rates right now. They have room to pump prime again. And that could stimulate the market. So in a way, we could say that the Fed put is still there. They are just slowly winding back, which is actually essentially quite good for the market. So at least we know that if things start to not work out, things start to go bad, there's still room for them to actually come in and save the market. So hence why generally we are still optimistic of the market. And for us, time and time again, we think it's very difficult to time the market. A lot of people have been asking me, in the booth just now, your fund have done really well. When is a good time to go in? I always tell people the good time to go in is whenever you have money. Simply because if you're a long-term investor, look at the track record, look at our track record. We have been there for a long time, and we have delivered returns for our investors. A good example would be during the COVID crisis, 2020. March 2020, I think KAF core income is down 40%. In the first 3 months of the year, down 40%. We ended the year up 70%. So imagine if you try to time the market, and you panic, and you sell at the low of the market. You have missed out most of the returns. So I think time and time again, people keep mentioning, if you miss out that few days, that few large spikes, actually you miss out a big chunk of the returns. So for us, we always tell investors, try not to time the market. Stick with us. And for us, we always try to, create value for our investors by, continually looking for areas where we can invest in. I think I will conclude my presentation today. I think my time is so close to coming up. Thank you very much.